This is Dan Miller with Miller Financial Group. Today I want to do a video on compounded earning, an investor's best friend. This is part of our Retirement Built to Last Investment Basics series. The benefits of compounding are many and pretty easy to see. We're going to use an example here, growth of an annual $5,000 invested each year, and we'll say that it's growing at a 6% annual rate. Well, if you just added that up each year, took 5,000 times 6%, $300, $5,300, and just added that up times 30, or took that times 30 years, you'd have a total of $159,000 when you do not count compound. But once the earnings are reinvested and compounded each year, instead you would end up with a total around $395,000. A significant difference, and you can see the powerful effect of compounding. So let's look at an example of how compounding and getting started sooner is much better than doing it later and waiting. $3,000 annual investment, we'll say, at 6% annual growth, and assuming that we reinvest all the earnings. Well, if somebody wanted to save for retirement at age 65 and they started at age 20, based on this example, they would have $679,500 at the end of 45 years at age 65. But let's say they waited and started at age 35, waited 15 years. Now they would only accumulate $254,400. But then what if they waited clear till they were age 45 until they started saving for retirement? Well, you can see in this example, they would only have accumulated $120,000. So disciplined saving early in life may produce very big rewards. And again, compounding is your biggest ally when it comes to saving for retirement. And this comes back to the old saying, pay yourself first, disciplined saving is worth it. So let's look at another example. Let's say that you have a goal that you want to save $1 million by age 65. And we're going to assume the same scenario, a 6% average return, and three scenarios, one starting at age 20, 35, and 45. Well, how much would you need to save starting at each of those ages? Well, at age 20, to get to $1 million, you would have to save $4,435 a year. If you waited till age 35 to get to $1 million, you would have to save $11,940 a year. But now let's say that you did not start until you got to age 45, and so you only had a 20-year saving period. Well, to get to $1 million, you would have to save $25,640. So as you can see, starting early has some big rewards. So again, it's better to start sooner than later. Don't put off starting to invest. The earlier you start, the longer your investments have the opportunity to grow and compound. And playing catch up, as you can see, can be later in life, can be difficult and costly to you. If you have any questions, talk to an MFG advisor today. Thank you for joining me for this video.